In 2023, the US stock market demonstrated noteworthy growth, and the most recent gross domestic product (GDP) readings surpassed predictions. However, according to Robert Kiyosaki, the author of Rich Dad Poor Dad, the situation may not be as optimistic as it seems. Today we're going to discuss the opinion of Robert Kiyosaki about a terrible financial debt that will result in economic decline. There have been 14 recessions since the Great Depression, and these are a natural part of the economic cycle. Experts are divided on whether the United States would experience a recession in 2024 or not, because their concerns about one in 2023 haven't materialized. Even though inflation recently reached a record high of 9.1%, it has since fallen to 3%, and despite the Federal Reserve raising interest rates, Kiplinger reports that consumer demand for products and services, including expensive ones like homes and cars, is still growing. An increase in credit card and auto loan delinquencies is the sole responsible warning indication. Author of the Rich Dad Poor Dad book series and financial guru Robert Kiyosaki recently posted an alarming tweet implying that stock market volatility could signal not only a recession but also a depression, despite the lack of urgent symptoms of the crisis. "I do not play the stock or bond markets," he tweeted. "Being an entrepreneur, I take too much pleasure in being in charge. All indications, however, lead to a catastrophic stock market catastrophe. If your investment portfolio includes stocks and bonds, please exercise caution and consider seeking professional guidance. I fear depression is on the way. Gold and silver have been dependable stores of wealth for millennia. These precious metals are an excellent inflation hedge because of their intrinsic scarcity. In contrast to fiat money, which may be manufactured indefinitely. Although headline inflation has decreased recently, the cost of essential needs, such as food and shelter, has not decreased. You may wish to reconsider these metals if you think inflationary pressures are still likely. In addition, gold and silver have long been seen as safe haven investments that offer investors protection from both geopolitical and economic concerns. Given their widespread recognition and worth, gold and silver have frequently been sought for as a haven during times of political upheaval, war, and other calamities. Exchange-traded funds, ETFs, such as the iShares Silver Trust and the SPDR Gold Shares, provide investors with exposure to this market area. But Kiyosaki claimed that he is staying away from the SLVs or the GLDs in an interview from earlier this year because he wants no counterparty risk. Rather, he favors tangible bullion. Bitcoin, according to some, is the new gold. Although Kiyosaki has long been a supporter of traditional yellow metal, he also has an interest in cryptocurrencies. He tweeted last month that Bitcoin to 120K next year. Given that the price of Bitcoin is already $26,077, Kiyosaki's price target suggests a possible gain of about 350%. The fact that there is a limited 21 million coins in total for Bitcoin is one of its attractive features. This is in sharp contrast to fiat currencies, which central banks are free to produce whenever they like. A notable characteristic of Bitcoin is its decentralized nature, operating independently of central banks and traditional financial systems. This feature allows it to serve as an alternative method for storing and transferring value, particularly in situations where a country's economy or currency is experiencing instability, enabling global transactions. While purchasing and selling Bitcoin has become more accessible, it's crucial to acknowledge its inherent volatility. Despite a 57% year-to-date surge, the cryptocurrency remains over 50% below its peak in November 2021, highlighting the unpredictable nature of its value. For those seeking a more stable investment avenue without the fluctuations associated with cryptocurrencies, exploring dependable income sources outside the crypto realm, such as investing in rental properties with as little as $100, could be a viable option, offering a hands-off investment approach. Economists are uncertain about the basis of Robert Kiyosaki's prediction of an impending market crash. Despite the current market rally, with the S&P 500 and Nasdaq composites showing significant gains, some attribute this surge to investor optimism regarding increased corporate profits linked to the growing influence of artificial intelligence. Nevertheless, Insider advises caution, highlighting that Kiyosaki, who has long forewarned of a market downturn, advocates investments in gold, silver, and Bitcoin, assets in which he holds substantial stakes. Kiyosaki has expressed his intention to leverage a market crash, asserting that the optimal time to amass wealth is during such economic downturns. What then is a recession exactly? Furthermore, what distinguishes a recession from a depression? A recession is characterized by a notable and extended downturn in the economy, but a depression is more extensive, severe, and long-lasting. Here is additional information about recessions. Although many Americans may believe that the nation is in a recession due to the financial strains brought on by inflation, and economic indicators like the GDP may indicate that a recession is occurring or imminent, The official call on the matter rests with the Business Cycle Dating Committee of the National Bureau of Economic Research. The period between a peak of economic activity and its subsequent trough or lowest point is how one definition of recession is put. This is dependent upon several monthly economic indicators such as employment, spending, and income. The Bureau of Labor Statistics reports that as of June, there had been an increase of 209,000 jobs and the unemployment rate was 3.6%, which further complicates issues. Even then, the NBER will wait to declare if there's been a recession in the nation until it has overwhelming proof. That much-awaited call may come even after the end of a recession. The GDP measurement has shown to be a helpful benchmark in the past. According to Michael Strain, an economist at the American Enterprise Institute, a recession frequently ensues when the economy contracts for 2 straight quarters, as reported by the Associated Press. Recessions have actually occurred 10 times in the past 10 times that there have been 2 quarters of economic downturn. Various factors can contribute to the occurrence of a recession, including sudden economic shifts like the impact of COVID-19's pandemic, inflation, the bursting of stock market bubbles, and defaults resulting from accumulated debt, which played a significant role in the Great Recession. Since the Great Depression, there have been a total of 14 recessions. The most recent one, triggered by the pandemic, lasted a mere 2 months, from February 2020 to April 2020, making it the shortest on record. Interestingly, this recession concluded before the National Bureau of Economic Research, the NBER, officially declared its commencement. Despite its brevity, the pandemic-induced recession had severe consequences, with the unemployment rate soaring to 14.8%, leading to the loss of 22 million jobs. It's crucial to understand that the NBER's identification of the end of a recession does not necessarily align with the financial conditions of individuals. Instead, it signifies the period when economic contraction ceases. A severe, sustained period of economic weakness is referred to as an economic depression. The United States economies didn't start to recover from the last one, the Great Depression, until roughly 1939. It officially lasted from October 1929 to 1933. The Great Depression saw a 30% decline in GDP and a 25% unemployment rate among the working population. Most people agree that this is the worst economic downturn in American history. The Great Depression was caused by several things. The 1929 stock market crash is a significant one. Barry M. Mitnick, a professor of business administration and public and international affairs at the University of Pittsburgh's Katz Graduate School of Business, told Insider that the crash was not a cause but a triggering event. The Roaring Twenties' reckless landing and spending purchases, along with the government's slow response, tariffs that prompted other nations to impose their own tariffs on American goods, and poor decisions made by the Federal Reserve, such as hiking interest rates and permitting failing banks, all contributed to the situation. The Great Depression lasted for a very long time because of all these reasons. Generally speaking, during economic downturns, consumer confidence and the stock market decline, while personal and corporate bankruptcies soar. A decline in employment and production corresponds with a decline in economic activity. The federal government strengthened its tools after the Great Depression to stop recession, which are a regular part of the business cycle. From worsening into depressions, the Securities and Exchange Commission was founded to regulate the U.S. stock markets, while the Federal Deposit Insurance Corps was formed to safeguard bank depositors' accounts. Currently, there are enhanced measures like unemployment insurance and an expanded set of tools in the government's monetary policy arsenal, which proved effective during the Great Recession. In response to the economic downturn, the Federal Reserve reduced great interest, and the government provided bailouts to major industries. This proactive approach resulted in a relatively short-lived recession of under 2 years, followed by a prolonged period of economic growth. Crucially, the critical indicators signaling a recession have not surfaced, minimizing the probability of a depression. That's all for today's video. If you liked the video, don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos. Let us know your opinion in the comments section down below.